This is a video demonstration on financial ratios. In this video, I'm going to work the solution to example number 4, and this is going to give us some additional practice on dealing with the financial ratios. In this example, we have two different companies, the Carter Company and the Dalton Company, and we have been provided with information on each. If we go down here and look at the requirements, number 1, for both companies, they want us to calculate the current ratio, acid test, working capital, accounts receivable turnover, inventory turnover, and profit margin. And then secondly, which company is the better credit risk. So we're going to calculate all these ratios for both companies and put them in competition with each other to see which one comes out with better answers. And it's probably not going to be necessarily a clear winner. We may have some where one company looks better than the other and vice versa. So we'll look at all 6 of these ratios together in order to answer that question and to make a decision. Now, whenever you deal with financial ratios, it's very important that you have the formulas memorized. The formulas are in the textbook, and they're also available in the various video lectures that we've had. And it's important that we know these formulas, and not only that we're able to calculate them, but also, even more importantly, we have to be able to explain the answer. And that's really the purpose, is to explain what that answer says about that particular company so that we can judge and analyze that company. So to do this, we're going to calculate these in Excel, and I've just set up a very simple and basic spreadsheet that has the name of each company and an area for me to put the answers. That way I can see how they directly compare to each other. Now, the first one I'm going to calculate is the current ratio. Current ratio, that is going to be based upon a simple formula, current assets divided by current liabilities. So for the Carter Company, current assets, $312,000, current liabilities, $123,000. So $312,000 divided by $123,000. I get 2.53659, or about 2.54. Then over on the Dalton Company, current assets $302,000, liabilities $90,000. And I get about 3.3555, or if I round, about 3.36. Now, the way I would interpret this, on current ratio, we want to see an answer of at least 1. And the higher the answer is, the better. If I round to the penny, this tells me that for the Carter Company, for every dollar they owe in the next year, they have potentially $2.54 to cover it, whereas the Dalton Company has about $3.36 to cover it. So really, they're both in pretty good shape, but we would give a definite edge to Dalton. They have a higher current ratio. Now, the next one that we're going to do is the acid test. This is a very similar formula. In fact, it's a more strict version of the current ratio. The formula would be cash plus short-term investments plus receivables divided by current liabilities. So for the Carter Company, we've got the cash, $45,000. We will add to that the short-term investments, $82,000. We will add to that the receivables, $105,000. So altogether that gives us $232,000. The current liabilities are $123,000. So those assets divided by the current liabilities gives us about 1.886, or about 1.89. And then I'll do the same thing for Dalton. Cash, $56,000. Short-term investments, $85,000. Receivables, $111,000. That gives me a total. Current liabilities, $90,000. Those assets divided by the current liabilities, I get about 2.8. Now, the way we interpret acid test is pretty much the same way you interpret current ratio. For every dollar they owe, Carter Company, under the more strict version, acid test, has about $1.89 versus Dalton that has about 2.8 or 2.80. So they're both in pretty decent shape, but definitely an advantage to Dalton there. Now the next ratio is going to be working capital. Working capital is simply current assets minus current liabilities. So for Carter Company, $312,000 minus $123,000, and we get $189,000. And then for Dalton Company, $302,000 current assets minus $90,000 current liabilities, $212,000. Now the way this is interpreted, the working capital is simply the money that we have to work with. It's the money we have above our debts, above our liabilities. So they both are in pretty good shape, $189,000, $212,000, but still a definite slight edge over toward Dalton Company. So far it looks like Dalton is ahead. Now the next one we're going to do is accounts receivable turnover. The formula would be net sales divided by average inventory or average receivables. Now this turnover is going to tell us how quickly we get rid of our receivables. We want that to be as fast as possible, because if we have a good high turnover, that means we're doing a good job on collecting the money. So it's going to be net sales divided by average accounts receivable. So for the Carter Company, net sales $850,000. Now look at the receivables, specifically the accounts receivable. They had $124,000 at the beginning. They had $99,000 at the end. I want the average. So this is going to be $124,000 and $99,000. And I want to add the two together and divide by 2 to get an average. And then I'm going to take those net sales and divide it by the average receivables. That gives me about 7.623. Then I'll do the same thing for Dalton Company. Net sales, $750,000. Receivables, the average of $102,000 and $94,000. And then I'll take those net sales and divide it by the average receivables. I get about 7.653. So they both have a pretty healthy accounts receivable turnover, and it's awful close. 7.62, 7.65. Pretty close. That means both of them on average turned over their accounts receivable about 7.6 times, almost 8 times in a year. So that's pretty good. The next one is going to be the inventory turnover. This is going to tell us how quickly we sell inventory. Again, we want this to be as high as possible. This formula will be cost of goods sold divided by average inventory. So cost of goods sold for Carter Company, $400,000. Inventory, it's going to be the average of 61 and 56. We get that cost of goods sold, we divide it by the average, that gives us 6.838. We'll do the same thing for Dalton Company. Cost of goods sold. Inventory will be the average of 89 and 91. We get that cost of goods sold and divide by that average, 3.58. So now we see a little bit more of a murkier picture here. We were doing really good on Dalton Company until we got to inventory turnover. Carter Company's got a much healthier inventory turnover, 6.8 versus 3.5. So that's a little bit different. Then the last formula is going to be the profit margin. Profit margin will be net income divided by net sales. So for Carter Company, net income $360,000. And then the net sales, let me widen this a little bit so you can see the number. Then the net sales, that is going to be $850,000. And then the net income divided by the net sales, 0.42. Then we'll do the same thing for Dalton Company. The net income, $400,000. The net sales, $750,000. The net income divided by the net sales, 0.53. Now on profit margin, you get a decimal answer. The decimal is a percentage. So 0.42 is 42%. 0.53 is 53%. So that means Dalton Company earns a slightly higher profit margin than the Carter Company. So that completes part one. And then for part two, to answer our question, well, really, I would say both companies are in pretty good shape. But if I absolutely had to pick one over the other, overall, I would say Dalton Company. Even though I have to admit, Carter Company had a much higher inventory turnover, but on everything else, Dalton Company had a much higher answer. So chances are we would tend to favor them as a better credit risk.